recording is full. Okay, anyway, they will still give me the recording until middle of this week. For some reason, our recording has been taking up a lot of space, and I think I will have to upgrade my account to get more feature. So anyway, if you can see me, can you see my slide? I can't see my slide too. All right, I'm sure you can see my slide now. There's anything you cannot see or you want to highlight to me, you got to do it while I'm still trying to figure out the setting here. Okay, so now without much ado, let's get started. Now this presentation is by no means an offer for you to buy, or for me to offer you to buy or sell any kind of securities, be it futures, options, CFDs, current FX, or even cryptocurrencies. So definitely the trading of any kind of leverage products do carry the element of risk. So do understand your own risk profile before we get started. And of course, there will be a large segment in which I'll be sharing you my opinions. And these are my opinions. It's got nothing to do with my company, Traders Academy International, Private Limited. And therefore, I will not be responsible for anything that you do as a result of attending this presentation here. Okay, so let's get going. Now, the first thing that came to the first statistic that was released this week actually was pretty light, except for the CPI numbers that we are waiting to see on Thursday. So on Wednesday itself, we have the Australia releasing their monthly consumer price index. You'll notice that this chart do not have very long history because they only launched this last year. So we can see that this is a new statistics that's been released by Australia. And we can see that we do not have a lot of history to go with. So we can see, generally speaking, Australia inflation situation is still very much in play. The latest number coming in for the month of November is at 7.4%, whereas we have already seen most of the other major economies, inflation has started to dip, but for Australia, it is still climbing. So of course, it came in from a low level of 6.9% in October. So for the month of November, it went up to 7.4. So maybe because if we use the other major economy inflation numbers for December as a guide, maybe we should see some kind of tapering off when the December number is up. So in the meantime, this is all we have for November. The latest is 7.4. Okay. Retail sales seems to have been doing very good. Okay, we can see that in October, retail sales was for the first time negative in 2022. And for the month of November, it actually bumped up to 1.4%. And this is definitely something to celebrate. It means that Australian consumers are by and large still confident and they are still spending. So this could only do well for Australian GDP going forward. So has the Australian dollars actually gone up? Yes, it has, but not so much because of the retail sales. It has been going up for quite some time now. In fact, since the beginning of the year, we have only been 2 weeks of trading, actually less than 2 weeks, okay, because we have holidays in between. And by the way, Monday, tomorrow, we are going to have a US holiday, which has the Martin Luther King Jr. birthday, which is celebrated in the States. So tomorrow in US, there will be no market. So, but the rest of the world is still open for business, okay? Then we have the trade balance. Again, it is a good number. The market was expecting $12.944 billion. It came in excess of $13 billion. So this is definitely something to celebrate again. It has been climbing since July of this last year. So we can see that it is nowhere near the peak, which was in June of last year. But you can see that over the last 5 months, Australia trade balance has improved. And now that their relationship with China is looking to be thawing, meaning to say that the hostility between Australia and China seems to be cooling down because there's a new government in place, and I think they have reached out to the Chinese, and I think trade relationship between Australia and China will be more or less back to some kind of even keel. And if that's the case, then Australian trade balances should be doing well, because if China do well, Australia typically have done well. In fact, over the last 30 years, as China was growing exponentially, you can see that Australia did not go into a recession for 30 years. So you can see how much of influence the Chinese economy have on the Australian economy. So any kind of good relationship between China and Australia would definitely be shown up in good economic numbers for Australia, and this trade balance is definitely going to look even better as the months goes by. Okay, assuming that the relationship between the two of them do not take a tumble for the worst, so we will have to watch this space here. But generally speaking, the optimism is slowly returning, and with China opening up, that means there's going to be a lot more business that can be done between Australia and China. Okay, now China's consumer price index is mysteriously still under 2%. So this is something that we have to watch very clearly. A lot of people are saying, hey, this number reliable or not? Because the world is seeing elevated prices, whereas China inflation is below 2%. So this is something that is a little bit weird. But if you look back over the last 3 years, China have intermittent lockdown, especially at the beginning of this year. We can see the lockdown has actually become very intolerable to the point whereby citizens has actually come out and actually violently protest the continued lockdown. So imagine if you are locked down, you can't spend. So if you can't spend, inflation is not going to be a concern, right? So that is maybe working out to be the reason why we can see China inflation scenario is very different from the rest of the world. They do not have inflation. Based on this number, it is definitely not non-inflationary. So now it's a different story now. Okay, now they have already do away with the zero COVID policy. The protocol has been so restrictive to the point where factory cannot open. People may be locked down just because one individual is infected. Okay, so now the Chinese are perhaps looking forward to spend. Okay, and over the last couple of weeks, we have seen the Chinese has been pouring out of China, and they have been going on the revenge traveling. Okay, so that is something that will spill over into places that welcome the Chinese tourists, including Hong Kong, including Macau, including Singapore, for example. But places like Japan, places like Korea, is beginning to see a bit of a pushback by the Chinese, whereby they are retaliating for these two places, whereby they insist on Chinese tourists coming in need to be vaccinated 48 hours before showing up, and then they have to take the art test, and then they have to walk around with the dog tag, what you call the lanyard showing that they are from China. Even babies that are in their arms of mothers have to put on that lanyard. I think the Chinese don't like that because they feel that this is basically discriminating against them. So if that's the case, then maybe places that do not so-called welcome the Chinese tourists may not benefit from this rush of this mainland Chinese going out of China to actually go out and relieve themselves, because they have been locked down for so long and they just want to have a breath of fresh air. Okay, so maybe domestically, that will also translate to higher consumption and perhaps higher inflation in the months to come. So again, this number that we have to contend with, as far as the Chinese CPI is concerned, it has been mysteriously has been very benign. Okay, and that could be the reason, because it has been locked down intermittently to the point whereby the saving rates has actually soared. Okay, over the last 3 years, you can see that the Chinese have been saving a lot of money because they couldn't go out. So this is going to work in their favor. Okay, because the rest of the world is drowning in debt. Okay, so the Chinese consumer actually accumulated a lot of savings, including the first is China, the second is Singapore. So the saving rates in these two countries is going to be a buffer in the coming turbulence that we're going to experience. Okay, so this high saving rate is possibly going to be a game changer, okay, relative to those countries and consumers in those jurisdictions that have already depleted, they have already maxed out a credit card, and credit is going to be so hard to come by, because we are seeing something in the States. We are there's this thing called the reverse repo. Okay, if the Federal Reserve wants to inject liquidity in the market, they will do repo, in the sense that they will they will buy the bonds from the banks and then inject cash into the system. And then once the bank got the cash, they will be more willing to lend out to consumers, to corporations. So this is to inject liquidity into the economy. But of late, we see there is something very different. We are seeing a reverse repo. In fact, the banks are flush with cash, even at higher interest rates. Typically, what you would expect the bank to do is to go out and make loans, but the banks are so worried about their customer, whether they are consumers or whether they are corporation. The banks are not willing to lend even at higher interest rates. Okay, so what they do is that they park the money with the Federal Reserve to earn secure money, risk-free money. Okay, so the Federal Reserve right now is flooded with liquidity. But what they need is for the liquidity to move back into the market. So in the States, you can see that credits are hard to come by. Okay, so this is going to be setting the stage for a credit crisis that we are already seeing developing in all over the place. Okay, whether it is in UK, whether it's in Europe, or whether it is in Japan. Okay, so in the States, we have this phenomena whereby we have this reverse repo going on, which is telling us the banks are so scared of lending because they are not sure that if something bad happens, those loans can be recalled. Okay, so this is going to be something that we also need to be concerned with. Okay. So now as we go forward, you can see the US consumer prices. This is fantastic news. Of course, we can see the headline numbers for the CPI numbers represented by the blue line has peaked last June at 9.1%. So this number that they were just released on Thursday was even better. The market was expecting 6.5%. Okay, exactly where it was, but if compared to where it was just a month before, in November, it was 7.1. So this is 6.5. Now, I have always tell you that this number is nothing to celebrate. It is a number that has been fudged so many times, whereby they have massaged this number to make it less severe. At the retail level, inflation is nothing like this. Okay, obviously we can see energy prices coming off for the first since March, April of last year. We can see it has been sliding back. We see natural gas prices continue to chart new low this week, and crude prices has actually rebounded a little bit, but natural gas is continuing to slide. It did bounce at the beginning of the week itself, but towards the last day of the week itself, it slid back to new low as far as this year is concerned. Okay, so it has been going down. So that has actually tamed the headline inflation number that we are seeing here, 6.5%. Anybody who look at this number would immediately celebrate. Okay, what they do is that they think that the Federal Reserve right now would have less reason, okay, to continue to hike rates. Okay, in fact, the market right now is betting against the Federal Reserve, thinking that at some point they're going to stop. Okay, and we are not that far away from the next FOMC meeting, which is going to be scheduled on February the 1st. So the market expectation now is that based on such good headline numbers, inflation, maybe they do not even have to hike 50 basis point or 0.5% interest. Okay, they maybe can do 25 basis point or 0.25. So the market has already priced in a 0.25 rate hike from February the 1st. Okay, so whether that will be the case, we will have to see. But definitely based on this number, people have expectation. Okay, but the Federal Reserve has been telling us they're going to keep interest rate higher for longer. Okay, there is that risk where the Federal Reserve may already has already done what it can do already. So if they continue to hike rates, it's going to cause a cascading effect because credit are hard to come by. Consumers are really badly hit by higher interest rates. The real income has actually dropped because even if the headline inflation is at 6.5%, interest rate right now is still 4.25%. So we still have about 2% real inflation in the economy. So unless wages catch up, which I think the Federal Reserve is very careful, try not to excite corporation from increasing wages, because once wages goes up, it's very hard to bring it down. It's unlike trying to influence the price of commodities. Okay, wages once goes up, it's like giving a child a sweet, once you give the child a sweet, you cannot take it back, because when you do take it back, the child is going to cry. Okay, so it's the same for consumers. Once wages goes up, it's very hard to bring it down. So they are trying not to create a condition whereby wages are climbing. But in fact, in the US, we are already seeing signs that wages are climbing, and people are very selective. Now we have looked between the blue collar and the white collar jobs. Blue collar jobs, you cannot work from home. There's no way you can get an engineer to work from home, right? For the white collar workers, they have the option, because during the lockdown period, everything pivot to offline and to online, and those white collar workers can actually work out from their home. Okay, companies like Tesla has been telling us this is not going to be sustainable. They want those workers back in the office. So if workers have options, you say, I can go back to office, you're going to pay me more. Okay, so I think companies who are faced with this twin issue of something very, very unusual, whereby workers are allowed to work from home, because you cannot monitor the productivity, right? So companies are a little bit concerned about that. But there are companies that are allowing workers to work from home. Again, you got to see whether they are blue collar or white collar. Okay, so the consumer price index, as far as the core inflation, which is the orange line, has also dipped down. Okay, it's now at 5.7% for the previous month of 6%. This is, of course, not taking into consideration the energy and the food prices. And again, food prices have not come down significantly, unlike energy prices. So as we go into further into the winter, okay, we are still in the mid of winter. And this year winter, for the United States, they have a little bit of different situation compared to Europe. We have flash flood. We have severe cold weather snaps from the Arctic. Okay, for the United States, it seems that this year the winter is a bit colder than normal. We have seen people vehicles got stuck in a highway and covered on with snow, and there have been fatality. Okay, something very different from Europe. Okay, although we still have that blast from the Arctic, but it was not the kind of severe winter that people were fearing going into this season itself. So different dynamics. Okay, different kind of results. So energy prices has stabilized, although natural gas is continuing to slide. But I do foresee that with China opening up, there will be more demand for energy prices. Eventually, energy prices will have to reflect the higher demand coming out from just one source, which is China. Now, China has been the biggest importer of energy products, especially crude oil. So with China looking to open up further, obviously demand for energy is going to spike, and that is going to it's going to work out in terms of higher energy prices going forward. So if energy prices start to go up again, and then food prices has not really significantly come down. In fact, we are seeing the exact opposite for food production. We are seeing less supply available for food, because in places like Denmark, places like Holland, places like New Zealand, they have been buying up the farmers' land and telling the farmer, they're going to take over their land because they're producing too much nitrogen, for example, which is going to be bad for the environment. So over time, okay, all these food producing countries, okay, they are sufficient in food, is going to see a situation in which they have to import food, and this will be competing for food sources in the months and years ahead. Okay, so food prices is definitely going to be something that you want to be concerned with, because we are seeing this headlong rush to try to tackle climate change, okay, to go carbon zero, which I think is going to work out to be a disaster for mankind. Okay, so definitely food is going to be a concern. So if we consider food is going to be a major component for CPI, and energy prices are likely to be higher going forward because of China opening up, then this inflation is not going to go away. Like I mentioned previously, when China is under intermittent lockdown, nothing gets out of China on a sustained basis. Factory cannot open regularly, people cannot go to work, and obviously the export of China goods, cannot go out. Okay, so that has managed to actually tame inflation in a certain sense. Although you can also relate that to higher inflation, because if Chinese has been exporting cheap products to the rest of the world, it actually allows consumer elsewhere to enjoy lower prices. Now, if China don't export, obviously there will be a shortfall in supply, and prices naturally will go up. Right now we have a different dynamics. Now, if China goes back to reopening, and if they go back to some kind of normalcy, factories will be humming along, and that means instead on top of higher energy needs, they will be selling more. When they sell more, do you think this is going to be good for inflation? On the one hand, it may cause price to come down, but on the flip side, if China is opening up, they tend to consume more as well, it's also going to raise inflation. So, depending on how you look at this spectrum here, China opening up can actually work against the central bank's concerted effort to cap demand. Okay, so right now we are a bit of in a quarrel here. Is China opening up good or bad for inflation? Okay, so from the central point, from the central bank's perspective, if I am Federal Reserve, I'll be very concerned with China going back to normal. Okay, because as I appear to be winning the inflation war, China opening up can actually cause another wave of inflation. Okay, if China are beginning to export, not sure how American consumer is going to react. Are they going to buy more? They could. Okay, for all we know. So again, we have to see in the months ahead how China opening up is going to impact the inflation story that we've been talking about. Okay, so consumers' confidence seems to be returning in the state. This was the last number to be released this week itself. We can see that based on the Michigan Consumer Sentiment Index, you can see that American consumers' confidence is back. They are almost at 65, which is so much better compared to the middle of last year. You can see last year, the lowest it ever went down was 50. Now it's almost at 65. Very, very close to where it was before the war in Ukraine. Okay, so we can see that by and large, Americans are feeling a little bit more confident, but I think this confidence here is misplaced. You got to watch out for this. And very similarly to what we see in the stock market, we have seen a bit of optimism in the stock market since the beginning of this year. And we are only in the second week of 2023. We can see the stock market has been very, very optimistic. You can see prices have been going up. So we have to take this with a pinch of salt. What I'm afraid is that they are going to be lured into a false sense of security. Okay, so now let's continue. I promised to tell you the various YouTube channel that I do follow to get alternate views rather than depending on mainstream media reporting. So do remember, tomorrow, January the 16th, is going to be a US market holiday. Martin Luther King Jr. is celebrating his birthday, or rather people celebrate his birthday. He's no longer around anyway. So what we see here is that Monday is going to be closed in the States. So do watch out for that. Okay, do not look at the screen and decide, hey, how come nothing is moving? Okay, because they are having a holiday. Now, this is to what we can expect in the coming week. It's going to be packed, okay, with a lot of major statistics that are going to be released, except for the United States. We only have one major number for the States, which is retail sales. It's going to be a big number anyway, but there's only to be one for the United States. For the rest of the world, we can see that China is going to start the ball rolling. On Tuesday, we're going to have the release of the GDP numbers. It's going to be a horrible number. We are already prepared for a horrible number. The previous, for whether it is quarter on quarter or year on year, we can see the previous was 3.9%. They expect on a quarter to quarter less than 1%, and then for the year on year less than 2%. Now remember, China aims for 5%, so we are very far away from where they need to be. Okay, so retail sales in China is also going to take a knockdown, because this is before the announcement, just before the Christmas that they are opening up. So we can see that this is still reflecting the pre-opening up situation in China. Retail sales is still going to be bad. From negative 5.9, they're going to expect negative 7.8. This could be the last bad number coming in from China as far as retail sales is concerned. We're going to see increasingly better number as the months goes along. And then of course in UK, we're going to see how the labor statistics look like. We're going to have the claimants count change, which is very similar to the US unemployment benefit. Okay, see how many people are going to ask government for handouts. Okay, so the number is, there's no consensus this time. For some reason, nobody is giving any consensus because maybe they do not know what the number to expect. But the previous was 30.5 thousand UK's BRICS are looking out for handouts. Okay, so we can see unemployment rate is likely to stay stable at 3.7%. If the US is going to be any guide, remember we saw the non-farm payroll 2 weeks ago, in which US unemployment rate has slipped back to 3.5% from 3.6%. So we can say that maybe this is going to be something that we can also see in the UK. So if unemployment rates continue to be still low, okay, anything lower than 3.7 is considered low because we are looking from a relative point of view. And this is not something the Federal Reserve or even the Bank of Japan the Bank of England want to see. They want to see destruction of jobs because they are trying to destroy demand. Okay, so if this number does not climb, it means the Federal Reserve or central banks cannot take their feet off the gas. They will continue to increase interest rates. Okay, so in order to have some kind of evidence that a high interest rate has killed off demand, they must see higher unemployment rate, which is something counterintuitive. How can something that bad be good for the economy? But this is exactly the thinking right now. Okay, in order to tame inflation, they need to kill off demand. In order to kill off demand, they must kill off job creation. Okay, so take some time to come around to this idea. So of course, we also have Canada. We're going to have the consumer price index. There are two sets of inflation numbers coming in from Canada. Okay, the one that you should be looking at is Bank of Canada Consumer Price Index. There is another one, a plain vanilla CPI. Okay, so both are released at the same time on the same day. Okay, so the one that you want to concentrate on would be the Bank of Canada Consumer Price Index. Year on year, they expect it to actually climb to 6.1%. So as far as Canada is concerned, they are expecting continued elevated prices in the economy itself. So again, there's no reason for the Bank of Canada to actually ease off hiking interest rates. Okay, so on Wednesday, we're going to see how Japan is going to react as far as interest rate is concerned. No surprise here, nobody expect them to move on the interest rate front, which is currently negative 0.1%. And what we want to see is that speech. Okay, remember the last time they did not move the needle for interest rates, but they actually widened the bond yields cap. Okay, from 0.25, they raised it to 0.5, and that caused the market to go into a spasm because this was totally unexpected. And now it seems that the yield on JGB, which is Japanese government bonds, is already beyond the cap, okay, of 0.5%. So it looks like interest rates in Japan wants to go up. Okay, so on this front, maybe we will have to look for look out for the speech by the governor of Bank of Japan, Kuroda, see whether he's going to further widen the yield cap. Okay, if they further widen the yield cap, the yen is going to fly. Okay, it has already flown. Okay, so the thing is that would it fly even far higher? The question right now is that cheap interest rate in Japan is going to be something of the past because their policy has failed miserably. Japan have come down to the idea that it is impossible to fight the market by trying to suppress the yield from climbing because elsewhere the yields are already surging except for Japan. So people have been borrowing cheap Japanese yen to finance for that play what we call the what you call it. There's a phrase for it. I can't remember. Okay. Anyway, what people do is borrow in Japanese yen, take the money, go and reinvest in another risky assets. Okay, whether it is equity markets or in currency market. But people have been doing that all this time because Japan has been locked in a situation whereby they cannot afford higher interest rates. But things are changing because they realize the capital have been flowing out of Japan big time because they still maintain negative interest rate where the rest of the world has already moved from 0 to 4.25%, 4.5%. So the interest rate differential between, let's say, the US and Japan is widening so wide to the point whereby money is actually flowing out of Japan left, right, center. So they cannot allow that to happen anymore. So they must allow interest rates to go up in Japan. And right now, everybody is looking at the cross rates, not so much on the dollar versus the yen. It is the all currency against the yen. Okay, so if you notice Aussie yen, for example, okay, the Aussie yen has been coming down and it's coming down very aggressively. Okay, good thing I'm short Aussie yen. Okay, now the thing is this: the expectation is that because the Bank of Japan has allowed yield to actually float higher, that means the yen interest rate is going to go up. It means the yen is going to be stronger relative to the other currencies. Yes, it is still very far away from where the other currency interest rates are. But for the time being, we can see that there is a seismic change in terms of the monetary policy for the Bank of Japan. People are buying yen big time because they think that because yen has been kept so low, the yield has been kept so low, interest rate has been so low, they have a lot to catch up. Okay, so speculators are buying yen big time right now. So do understand the dynamics behind this Bank of Japan interest rate decision. No major policy change is expected here, but if they do, maximum they do is maybe go back to zero. They're going to do away with the negative interest rate, because that nonsense that we saw about negative interest rates, we know it is a failure big time. Okay, many countries have practiced negative interest rates. They also abandoned. So the last country to abandon negative interest rates looks like is Japan. Okay, then we have Australia. Again, unemployment change. I'm going to see whether new jobs are being created now. This time they do expect less new jobs will be created. Previous month we had 64,000 new jobs being created in Australia. Now they expect a climb down to perhaps 22,000 new jobs being created. So that's a climb down. So that is evident that jobs are being destroyed. Okay, so this is something that that will cause the Reserve Bank of Australia to actually take their feet off the pedal. Okay, unemployment rate they're expecting to hold steady at 3.4%, but again, ideally we want to see a higher number than 3.4 to complement with less job being created, so that the Reserve Bank of Australia can actually hold interest rate and not continue to high interest rate. Now remember, going into last year, the Reserve Bank of Australia has been telling the nation, telling Australians, go ahead, because we're gonna keep interest rate affordable all the way until 2024. So there was this big demand going on in Australia prior to the Federal Reserve rate hike cycle. Okay, so a lot of Australians are stuck. Okay, because they go out and really spend, because interest rate was low. People were buying, speculating, whether it's stock market or whether it's in property market. But those rates are no longer sustainable. Okay, banks are not so willing to offer fixed loan rate. Okay, so now they are doing the floating rate. So if you are an Australian who has committed to a big ticket item like a property, for example, now the mortgage rate has already gone up, and it looks like it's going to go up even further. So that's the reason you see property prices are not able to go up anymore. Okay, so now they're going to be hit from both sides, whereby value of the property they bought may have gone up in value, and then the cost of servicing their mortgage loan has actually gone up. So now they're going to be squeezed right in between, which is something that we are seeing all over the world. Okay, mortgage rates has gone up in the States. I think they are more than double. Okay, in the States, whereas property prices, at least the not the high end. I think the what you call it? They call it shelter. Okay, prices of shelter has actually come back down. Okay, so we can see that they are going to be squeezed on both ends. The value of those property they have already committed to has fallen in value, and then the cost of servicing the mortgage rate has actually gone up. Okay, so this is definitely not a recipe for success in the economy. Okay, so last but not the least, we have the Bank of China. The People's Bank of China is going to decide on interest rates. Again, there's no estimate. Based on previous example, where we don't expect them to actually do anything on the interest rate. In fact, China is one of the very few that have cut interest rates. Okay, last year they cut it down to 3.65. Okay, and they have kept it there. Okay, so if China wants to resuscitate the economy, because right now it is a game. China have a new team of economic policy makers. The prime minister has is going to be there will be a new prime minister in place, and I think the first thing that the new prime minister need to do is to resuscitate the economy, and obviously having lower interest rates helps. Okay, now the other thing is, of course, retail sales for Canada. They do expect a a deterioration from just above 1%. Now they expect the retail sales to go back into negative territory. So this is a mixed bag. Okay, on the one hand, if the Canada itself do expect prices of consumer prices to continue to edge higher, and then retail sales is coming back down. So this cannot be good for the GDP going forward. So this is all we have for the coming week itself. Let's continue to see now what are the various YouTube channels that I do follow to get a different perspective of what we have been fed by the traditional media. Okay, the mainstream media has always been feeding us. Remember, in the last few months, the one theme that has been feeding us is recession, recession, recession. This is something very different from the beginning of last year. We talk about inflation, inflation, inflation. So the recession theme has been hyped by a lot of major personalities, including the bosses of major banks in the States. Okay, we even have the IMF and the World Bank telling us the global economy is likely to slip into a recession. So this recession thing has been in our psyche over the last few months. Now, is it going to be this? Is it going to be the story? Okay, I think it will be. Okay. However, the fight against inflation, although we saw in the States, we can see inflation has been climbing down steadily for the last 6 months. I do not believe for a moment the inflation is the fight on the inflation front is over. Purely, like I say, China opens up, it's going to throw a curveball into this fight against inflation. Okay, China opening up can be inflationary. Okay, so do watch out for that. And of course, if the Americans wants to they want to decouple from China. They are trying to onshore most of the manufacturing. Now, understand the wages in the States are not cheap. Okay, so if they onshore most of the manufacturing, which we are already seeing in semiconductor, the chips that's going to be produced in the States, okay, it's never going to be cheaper than what they can source elsewhere. Now, China is a major buyer of semiconductors. So now the American has basically blocked the Chinese from buying any high-end microprocessors. So it means a source of income for all these tech company, okay, is going to be impacted. So where are they going to find a new source of revenue if the biggest buyer of their product is no longer allowed to, they can no longer be able to sell to them. So China will have a different set of problems. They will have the source for new production, new supplies. So internally, they will have to ramp up their the R&D as far as producing high-end chips are concerned. It will take time, but China will eventually be able to do that over the next few years. But for the time being, the high-end chips is going to be out of bound to China. Okay, so internally for all these microprocessors company that has been onshoring to United States, they're going to be stuck with high costs. Okay, and so much so even if they bring in the engineers from Taiwan, they have already gotten TSMC to actually onshore not only one plant. TSMC is actually building another plant to the tune of $40 billion, and TSMC is not stopping there. You see, the whole idea is that TSMC will be hollow out. You see why the TSMC move right now, not only to United States, to Phoenix, Arizona. TSMC is also expanding their production plant for high-end chips in Japan as well. So what is it telling us? If the American story is we want to onshore this very sensitive technology. We don't want it to fall into the wrong hand. And if it's going to be produced predominantly in Taiwan have problems because of geopolitics with China. If China one day decided to invade Taiwan, then they will be cut off from TSMC will be no longer able to produce enough chip for the rest of the world. So this is beyond what we have been told. TSMC has been moving to the States. They have not only moved to the States, they have also started to expand their operation in Japan, and that must be having the blessing of the United States. Now, imagine if all this high-end has been moved offshore, moved away from Taiwan. So Taiwan will lose the only card they have to prevent a Chinese invasion. So do you see the story here? There is definitely something that is moving beyond the narrative we have been told. Okay, so this onshoring of production into the United States sounds good from one perspective, but from the cost perspective, they can never produce cheap and affordable products. Okay, so that means inflation in the States. If Apple can only buy from American produced microchips, which Apple has already said that they are going to buy made in America, not made in Taiwan. Okay, so TSMC has been going to Phoenix, Arizona to set up plants. Okay, so if that is a case, then maybe they will buy from that plant and not that plant, those plants from Taiwan. Okay, so that means prices will stay high in the States because the unit cost is higher, cost of production is higher, so everything is higher in the States. So the cheap products that the world has been enjoying will no longer be true. Okay, going forward, we're going to break up into different blocks, and US will always be stuck in the high end, high cost production end. Okay, so inflation, I don't see how it can come down. One, we have China opening up, which may be inflationary, and then on this onboarding, onshoring of production, manufacturing into the United States can only be resulting in higher retail prices for American consumers. Okay, so this is one guy that I like. Okay, this guy is a economist, and he has a podcast which he does every month, every week. So I like his perspective. Okay, so his name is Peter Schiff. Okay, so you go and look out for type this word and search under his name. He has many YouTubes, and he has very different and sometimes not necessarily the same view as the narrative we've been fed by the mainstream. Okay, now the other one is this guy called Adam Taggart. Okay, he has a program called The Wealthian, and where he invites various personality to his talk show. And these are very long videos, easily more than an hour. And sometimes he has to break down the interview into two parts. Okay, for one guest. Okay, so he has very long video, but it's very interesting because the people that he invites to his talk show are definitely people who have very distinct view of their own. So this is something that I do follow, and because it's so long, I always listen. I will put on my earphone and then I will just listen to the talk show. Okay. Now, this is another guy. This is also an economist, but he doesn't give us, he gives us the big picture. Okay, Richard Wolff is another economist, and he's a professor, by the way. And I think he's a professor from Chicago University, and he does have not only economic view, he also have political views. Okay, so he's also somebody that also have a show that I also follow. Okay. Now the other one is this guy called Stephen Van Meter. His video are decidedly shorter, and he'd always talk about. Sometimes he has more than one video per week, and do follow him because I think his view is also very interesting. Okay, and he will tell you exactly whether this inflation that we are seeing released this week is going to be good or bad, whether it's sustainable, and how the Federal Reserve is going to react. Very, very good channel. Okay. Now the other one, this one is a very, very long one. This guy, I like him because he's very relaxed, and when he give his commentary, he's not very strict jacket. He tried to inject a little bit of humor into it, so you can actually watch this. The channel is called the Maverick of Wall Street, and this video is relatively long. Okay, maybe as long as the Wealthian series of YouTube videos, but very comprehensive. Okay, but it's a little bit more fun because it's less serious. Okay, so these are the few channels that I do follow. So if you want, do follow them. Okay. Now the other one, if you are interested in gold, this one is a very, very specifically dealing with gold and silver. It's called Live from what do you call it? Live from the Vault. Okay, the host is called Andrew Maguire, and the guy that he normally will be doing the commentary is this guy called Alistair McLeod, and this guy used to be a director of a bank, and now he's full time into gold. Now, you need to have a little bit of technical knowledge when you listen to this particular channel, because this guy is very technical. Some of the terms that he used, you want to go and Google exactly what those terms means. Okay, for example, what's LBNA? Okay, he's a very big picture guy. Okay, And if you want to know the big picture for precious metal, this will be a great source of information. Either you search under Alistair McLeod, because he also is interviewed by other channels. So not just the live on the board. Okay, you also want to check out this name, Alistair McLeod. Okay, he also sometimes appears in Wealthian, in which recently he was also interviewed by Adam Taggart in his program about his view on precious metals, and his views are very current. Okay, for example, he talked about the most latest one, why gold prices has been going up. He will give you the background story of why gold prices has been going up and why he think that we all must own gold. Okay, and he said if you don't own gold, you're going to be very sorry. And his idea of owning gold is not so much to make money. He said you want that to preserve your purchasing power. So very distinct view that he mentioned. Maybe the best way to actually benefit from his view is just to type Alistair McLeod, then you search under this name. Okay, this live on the vault is definitely one of the programs that he has been featured every week. Okay, now this is all I have for you for as far as the channels are concerned. Now let's go to, okay, let me see who else is trying to look up for me. Can't enter. Okay, let me see if I can get these people to enter the room itself. Now you guys must come in early, because once I started, it's very difficult for me to actually cater to you guys by giving you. Let me see how to invite. Let's see. For some reason, the interface looks different today. Okay, too bad. I don't think I can entertain him now. Okay, now let's continue. I want to share my chart with you. Let me see. Yeah. New share. Yeah, correct. Okay. Window. Yeah. Okay. Can you see my chart? If you can, just type yes in the chat so that I know that you can see my chart here. Okay, good. Now, this is the Dow Jones chart. You can see the Dow Jones has been up and up since the beginning of the year. You can see that this has already been trading. This rebound has been a lot more robust than I expected. I was previously expecting this rebounds to maybe be capped at 50%, maybe 61.8%. Right now, the market has already gone beyond the 78.6%. It does look like it may challenge the December high, but it is not necessarily a given. But based on the momentum we have seen over the last 2 weeks, it does look like regardless of the data, of course, the CPI numbers is the one that caused the market to surge one more round. And but we can see the market is ignoring another side news. Okay, the sub news is that yes, everybody is zooming on the headline CPI numbers and the core CPI numbers, but services inflation continues to go up, where the rest of the headline inflation has all gone down. Services PMI, services sub-index, okay, has actually increased. So as far as services is concerned, it's not getting cheaper. Yes, the other things are all getting cheaper, at least on headlines. But by many estimates, some private economists is saying that this number that we saw, 6.5%, is nowhere near reality. Okay, private economists have said based on what they have been tracking, using their own formulation to find the true level of retail prices, some of them are saying that it is above 30%. Okay, so this is very different from the 6.5 that we have been shown. So always take government statistics with a pinch of salt. So the government always trying to make it sound a little bit better than it is the case. Okay, so Americans are no different. Okay, so when you trade, you have to understand that governments do not want to project an image in which they have lost control or things are a lot worse than they actually are. So they do not want to create a panic situation. Okay, imagine if the Bureau of Labor Statistics announced CPI is at 30%. America will go bonkers, okay? And the government will, you can see people will be rushing out into the street and protest and trying to bring down the government. So you see, from where we think the inflation is, and from what the official numbers we have been fed, okay, it is heaven and earth, nothing reflecting the real situation. Of course, we are not living in the States, so we can't really tell, okay, really how bad is the inflation. So my worry is this, going into January, which is the first month of the year. Now, January has always been very, very interesting because if you remember last year, the market opens, it peaks immediately within the first 48 hours of trading for 2022, and then it has gone right down for 6 months. So right now we are seeing a very euphoric move, okay? Just thinking that the Federal Reserve may have to stop hiking interest rates. So the market has been buying, and equities have been very optimistic based on the idea that they think the Federal Reserve will have to stop hiking interest rates and maybe even cut interest rates. So the world market participant is actually betting against the Federal Reserve. Now, Federal Reserve have proven to be wrong big time. Okay, remember towards the end of 2020, they have been telling us inflation is transitory. Before they realize the inflation is not transitory, then they start to hike interest rate in March of last year. They have been behind the curve before. So we cannot blame market participants thinking that the Federal Reserve is again behind the curve. Inflation, based on the headline numbers that we've been seeing, has obviously come down. And based on that number, assuming that number can be trusted, then obviously there's no more need to hike interest rates. Okay, so that is the rationale among market participants thinking that they want to bet against the Federal Reserve. Remember last year, the keyword is don't fight the Fed. Okay, now the world is fighting the Fed by buying equities, risky assets, in anticipation the day will come when the Federal Reserve will have to stop. Okay, maybe that is so because we also saw dollar come down. Okay, as September last year, we can see this dollar actually peaked. If you look at the dollar index, it peaked in September last year, and he has been coming down, and that coming down has accelerated. Okay, what is happening? If inflation, if the Fed policy is to hike interest rate, that should benefit the dollar, and dollar shouldn't be falling the way it did. Okay, it has been falling since September. This is the 4th month, in fact, is falling, and the speed in which it's falling is a little bit concerning. Okay, so something else is moving. The dynamics doesn't make sense to me. If the Federal Reserve continue to hike rates, then rates should be strong, should be up there, and that should benefit the dollar. The dollar shouldn't be falling the way it is doing right now. Okay, so do follow the price action. Now, my concern is this: if price goes up first, okay, soon, I think it will be like maybe next week or the week after. Okay, the market will have to wake up to the realization that not all is rosy, and this is where the danger lies. The market has been lured into the false sense of security. Okay, because when you look at the prices of equities as shown by the Dow Jones, you can see the equity prices has been going up. Okay, so there lies the danger. I do not believe the US economy is out of the woods here. What we're going to get is continued high elevation of prices at the retail level. That means to say that inflation will come rolling back again, okay? And then this talk about recession will come into play because everybody is thinking, okay, recession is coming. I need to tighten my belt. I need to spend less. I need to prioritize my expenditure. So this will actually play out in real time, okay, over the next few months, whereby while they are tightening their belt, inflation is not coming down. Okay, so that is the danger. Instead of having a pure inflation play or a recession play, we probably will get a combination of both. Continued high prices and lower economic growth. The situation may be a little bit different for the United States because capital continue to flow into the States, okay? And this can continue maybe for short term, okay, because dollar is coming down. Maybe people are not too interested in parking money in the dollar. They may be for a time being parking their money in Japan because based on the very low level in which the yen interest rate is coming out from negative in territory, maybe the scope for more gain by parking into yen to earn the potential higher interest rates may cause money to temporarily flow back to Japan. Okay, so but over the longer term, I don't see how this thing can be sustained, because the Japan cannot afford higher interest rates because they have 240% of debt relative to the GDP. They can't afford. Okay, so high interest rate is going to kill them because the cost of servicing the massive mountains of debt is going to be unbearable. Something have to break somewhere. Okay, so we can see that this being the case, my worry is that we're going to see a very sudden turnaround in equity prices to the downside. Okay, this is what I'm more concerned with, because we see over the last 2 week, prices has been going up very steadily, and has been going up on a very sustained basis. This is luring a lot of retail investors to go in and jump to buy this. Okay, so be very careful. I do not for one believe that this is the case, but we are seeing a different structure in terms of equity prices in Europe. In the FTSE 100, in the DAX, we can see that they are almost touching record highs. Okay, and this is something that is counterintuitive to me. Okay, because I know for a fact the European economies, including UK, is in the dumpster. Okay, how can equity prices trading near record high? So all this is building up for a massive Humpty Dumpty. Okay, do watch out for this. Now in the S&P 500, we also see elevated price. Now prices is hovering towards the 78.6%. It has really gone beyond the 61.8%. And if it continue to go up, market is already above the 4,000 mark. Because going into this week, market analysts were saying, okay, if the S&P 500 cannot break 4,000, maybe it can do 3,995. But now it is officially above 4,000. Is it going to cause more knee-jerk reaction jumping into the market to buy? We will have to see. Okay, the S&P 500, if you are looking to buy, this is not the index to be putting your money in, because there is something else even more bullish than the S&P 500 other than the Dow Jones itself. Okay, of course the laggard has been this Nasdaq 100. Nasdaq 100 has managed to climb up to the 50% mark. Okay, to 11,547 this week itself, and it is hovering just under the 50% mark. We will have to see whether it had enough momentum to go even higher. So if you have to sell, this is to me the product of choice. If I have a bullish view, I won't be buying the Nasdaq. Okay, I will not be buying the S&P 500 because there's something better than S&P 500 based on the prices we've been seeing. Now, this other one is something that you want to consider, the small cap. Small cap has already punched beyond 78.6%. So this is the Russell 2000. It has been very robust over the last week or so. Okay, so if you have to choose, let's say for example, you have a very bullish view and you decided you want to buy equity index, this is the one. Okay, Dow Jones is very hard because Dow Jones is big, is the bluest of blue. Prices do not move as unless capital flows continue to come into the United States, and they are most likely to be parked in blue chips. Now, this is one index you can consider, the Russell 2000, because based on the price action we saw over the last 2 weeks, the move here has been outpacing the S&P 500. Okay, you can see clearly this market wants to go up and take out the December high. Okay, so again, depending on your view, I am not so bullish. Honestly, I have this nagging feeling that we are building up for a massive Humpty Dumpty fall. Okay, and we do not have to wait very far. If it's not going to happen in January, which I think it will most likely happen in January. Okay, my original target was 16th of January, but then I forgot it's a Martin Luther King Jr. holidays. Okay, so maybe it will happen on 23rd. So if it happen on 23rd, we are not that far away. It's only 1 week away. Okay, and if it doesn't happen in January, I think they cannot escape February. Okay, so I have a somewhat bearish view on US equities. Okay, let me see if you guys are asking me questions. I have to check this one. Okay, no question. No question is good. Oh, sorry, there's so many questions. Okay, let me see. My camera seems to be off. My camera is on. Maybe it's my internet connection. Okay, like I said, forgive me because I'm not fully prepared for this evening session because I just got back from KL and it was a bit of a rush. Let me see. The reverse repo mandatory instruction from Federal Reserve? No. Okay, when okay, this is backtracking a little bit. Earlier on, I did mention the repo and the reverse repo. If the Federal Reserve wants to inject liquidity into the market, okay, they will do the repo. It means to say that they will sell the banks, okay, their bonds, okay, and then no, sorry, they will buy bonds from the banks, and in exchange they will inject cash into the system. Okay, so if they want to do the reverse, they want to drain the liquidity, they will do the reverse repo. Now, this is something that either the Federal Reserve will initiate, but this time it doesn't seem it's the Federal Reserve that's initiating the reverse repo. Banks are voluntarily parking their money, even for overnight, okay, with the Federal Reserve, because that one is secure, risk-free. If they have a choice to lend out excess liquidity to counterparty within, let's say, their counterparty, okay, another bank, they are not so sure, even for the 24 hours window, the counterparty can pay them if something bad happens. So there is this fear right now that nobody trusts nobody. So the banks are rather goes and park their money with the Federal Reserve. So this is exactly what we are seeing. And the net effect is that there is a shortage of credit in the marketplace. Anybody who needs to borrow suddenly find that they cannot borrow because the banks are not lending. Okay, this is a very serious situation, because we're not talking about small numbers. We're talking about very, very big numbers. Okay, so this is not necessarily imposed by the Federal Reserve. It is actually done by the banks themselves. Okay, now based on my experience, which country economic data is more reliable and least subject to manipulation? I have no idea. I think they are all manipulated. Okay, but I have no proof to show you. Okay, but all I can tell you, I get this sense that all the numbers that we have been seeing, somehow they, if the numbers looks bad, they will come up with a different way of computing the statistics to make it look less severe. Okay. The CPI numbers in the States are a very good example. They have remodeled the calculation of CPI over the years, just to make sure that they do not project a very bad number to the public. Okay, so but they know those numbers impact the markets, because people are watching those numbers. But if you depend your entire analysis based on this number coming out from official sources, which has been fudged in the sense, I do not know whether those conclusions that you come up with is going to be anywhere near reality. So look at the prices. I have no faith in government statistics. Okay, maybe that's me. Okay, I become more cynical as I grow older. Now, how much China GDP data can affect the crude oil prices? It is now the understanding. There is no official number, because GDP numbers are released every quarter. It is no use to a trader who to depend on a number that's going to be released every 4 months. Okay, so it is not so much the official number. It is the feeling, the logical conclusion that if China open up, the factories are going to be humming along at full speed, then obviously the demand for energy is going to go up. Okay, so that is the reasoning why I think China opening up can be inflationary, because China will demand more raw materials, whether it is iron ore or whether it is crude oil import. They're going to demand more, because factories will need all this material to produce goods and services which they can export to the rest of the world. So yes, it is not so much on the GDP numbers, okay, because that will be delayed information. Carry trade, yes. Earlier on, I was trying to come up with that term where people borrow in Japanese yen and take the proceed to go and invest in other risky assets. Yes, the keyword here is carry trade. Sometimes I get this mental block. Sometimes I know what I was trying to express to you, but the word just refused to appear. Okay, maybe it's age. Now, Peter Schiff is generally perma bear. And in his podcast, he always based on gold and dividend stocks. Yeah, you see, when I listen to different podcasts, regardless of what the product they are trying to express their interest in, I will listen with I try to be balanced. Okay, I know they are trying that. They are definitely pushing an agenda. They are pushing a narrative. Okay, but I will have to listen to their reasoning. Why they think this gold market tends to be we should own gold, okay? And why equity market is not somewhere you want to be in with 2 feet, okay? I understand that he has an agenda that he's pursuing, but I like to listen to alternate views. So I take the good with the bad, okay? Dennis Coy said, are we expecting something on 16th or 23rd? Now, 16th is going to be tomorrow. Tomorrow is Martin Luther King birthday. And because the US market is not open, maybe we have to shift that target to 23rd. Okay. Like I said, if it doesn't happen in January, it's still going to happen in February. Okay. And this because you see, if the prices goes up the way it did, and it just looks like it's gaining momentum. So what it's trying to create is that sense of complacency. Now, if we have been holding on buying for the last 2 weeks and you look at, oh, prices have been going up, if only I had bought 2 weeks ago. So now you have this FOMO, fear of missing out. Would you be buying when market opens this coming week? And if you buy, you'll want to see higher prices beyond the entry price. What if that higher price do not come and you get the exact opposite? Then on hindsight, when you look back at where you bought and where prices is going to be, then I think you'll be looking at, oh, I should have waited. Okay, I shouldn't have rushed in. So again, the fundamentals doesn't make sense to me. Okay, maybe I'm also a permanent bear. Okay, maybe like Peter Schiff. Okay, so yes, okay, good. The question has stopped. Let me see. Oh, there are some more here. Okay, upside is due to the January effect, perhaps. This Wayden is saying, January do not necessarily have upside effect. Okay, remember last year, it did not have upside effect. Okay, in fact, it peaks within 48 hours after market reopens for the new year, and then it has been on a one-way track down. Okay, so that was not necessarily the rally impact. Okay, so January has always been very, very interesting for a trader because at the start of a new year, remember the start of a new period. Now, if you have been trading for some time, you realize sometimes the market sentiment will change from going into a new week. Monday, market performance will be very different from the last week performance. And it's the same thing from day to day. It's the same thing from month to month. Okay, so the start of a new month sometimes can cause the market sentiments to flip. Okay, so whether if its market has been going down prior to the new month, okay, then the new month may see a counter trend move, a counter reaction move. Okay, so this is a new period. So now we are talking about the start of a new year. Okay, so in January is the start of a new year, and last year we saw the extension of the fall from December. Remember, December prices has been falling almost non-stop. And January, for some miraculous reason, market started to reverse trend going up. Okay, so it's a start of a new period. Every time there's a new start of a new period, be aware of a counter move. Okay, here it says if the recession or high inflation hit, most of the investors will invest in gold, sir. Okay, right now, you have to understand gold has not been a good hedge on inflation. So the idea that because there's high inflation, therefore you buy gold, that theory does not work last year. Last year we have very high inflation. Gold did not pick up. In fact, gold only started to go up in November last year. Okay, so I would not necessarily look at gold being because inflation is high, therefore we buy gold. And the other thing that you ask is, if the stock market is not doing well, then maybe we should pivot to a risk-off attitude in which you want to hold on to risk-off asset, which gold could be a risk-off assets. But more importantly, I've always mentioned gold will really shine, okay, if we see or if we hear reports about massive protests that has gone violent, if there's bloodshed on the street, and if Americans fight against Americans, that means they have loss of faith in the government. That's when gold will really, really shine. But this year, in fact, the whole of last year, ever since the start of the war in Ukraine, something major has shifted, okay? Because the US has frozen the reserve of the Russian central banks. Everybody set up because of the move, because the US has politicized and weaponized the political system, the monetary system. It has weaponized the dollar, okay? So everybody since then has been trying to de-dollarize. We have seen this wave, and we have talked about commentators say, oh, China and Russia is leading the world to do away with the dollar, to kill off the dollar. But I think the world is like reacting to something very natural, okay? If your asset is in somebody's hand, and if somebody decided at the whim of the moment to decide that they want to freeze your asset, wouldn't you be very concerned? I'll be very concerned. So the whole world is watching what the US did to Russia's central bank's reserve. And they woke up to the realization today, I may be a friend of the United States. Tomorrow, if whatever I do or say is not in line with the American objective, then America can do the same thing to them, like what they did to Russia. So everybody is trying to de-dollarize. And one way to de-dollarize, for people with many assets stuck in the US, the Saudi Arabian, okay, has bought a lot of US Treasury, okay, because of the petrodollar, right? China, because they are the second largest economy, they has been selling a lot of goods to the United States. In exchange, they accumulated a lot of dollars, which they park in US Treasuries. Now, even allies of the United States, whether it's Japan, whether it's the UK, or whether it's Israel, everybody last year have seen a marked decrease in the holdings of US Treasury. So what you have to do is you sell off the US dollars and you buy gold. So this is what is happening right now. The world is buying a lot of precious metals. China bought a lot of gold last year, okay? So is Russia, so is Turkey. India is buying a lot of silver, okay? So the world is transiting away from dollar and to park in something that they feel will hold its value, and that has been precious metals, not the inflation story that we've been the theory of high inflation. Therefore, you buy gold. This is not what is happening. And of course, another darker motive for China massively accumulating gold in the open market, okay, is that they are getting ready for war. Is it possible? I think this is very possible. And this is a very scary thought, okay? They have seen how Donald Trump came out with America First policy has been targeting China. Biden has doubled down, okay? And he's only into his first half of his term. He has 2 more years to go, okay? And it does not look like, whether it is Democrats or Republican, they all are targeting China. So China have realized that no matter what they do or what they say, the US is going to go after them. Eventually, if something bad should break, okay, somebody is going to fire the first shot, and your assets in the States is going to be likely to be frozen. So China has been dumping US Treasuries, buying and take the proceed to buy a lot of gold, and they are getting ready for the day in which they have to go head on with US over Taiwan. Okay, so this is just my speculation. Now, will 4,050 be a key resistance for sell-off for S&P 500? Look at the December high, where the December high is going to be the pivot point. Okay, I do expect them to challenge that number. Okay, but the question is that can they stay above, and for how long? And if at the break of the end of this month, the market actually went up to challenge the last December high in the S&P 500, but at the flip to a new month in February, prices start to come back from the last December high. That is the reversal I'm looking for. Okay, so the end of January and the beginning of February is a new period. I look up for sign for a new period. Of course, I can narrow it down for a change in the week itself. If by the end of this week, the December high is crossed and the start of a new week on January 23rd, the price come back down, that is also my reversal signal. Okay, so I will look at it from the weekly time frame, and I will particularly look at it again in the monthly time frame. So the change from a new period into a new period has always been pivotal. So do look out for the change on period, whether it's on the weekly time frame as we go into January 23rd, or we go into the February the 1st. Okay, February the 1st coincide with the FOMC, so that is another danger period. What if the market had been expecting a 0.25 interest rate hike? The Federal Reserve came out with 0.5. All hell will break loose. Okay, so we are gearing up for something unknown, and this unknown can be a bit hairy. Okay, now camera is working fine, thank you, sir. And so repo is considered as quantitative easing and reverse repo. Oh, I'm not talking about repo, I'm talking about repo. Repo is a repurchase agreement. Okay, repo. Maybe my pronunciation gives you the impression I'm talking about repo. I'm not talking about repo, I'm talking about repo. Okay, repurchase agreement. Okay, so here the question is, Ryan says, so repo is considered as quantitative easing? No, it's a overnight operation. Quantitative easing means you want to flood the economy with a lot of liquidity. Okay, yes, taken from the angle it is, but quantitative easing is more sustainable, whereas repo is a overnight operation, 24 hours. Okay, on the weekday, day to day, when the market closed in the United States, okay, then those financial institutions, because of reserve requirement, if they do not have enough cash, they will want to borrow from their peers in the banking system, just to borrow for overnight, just to fulfill the reserve requirement by the central banks. Okay, so once they got over to a new day, they will return back the money. Okay, so this is a very short-term kind of what I call liquidity play. Okay, not something like quantitative easing, which is going to be more sustainable over a longer period of time. Okay, but it has the same effect. This is when they do repo, they're injecting liquidity into the market. But if the market is so tight, they want to inject liquidity. Okay, but now it seems that the market is flooded with liquidity. The banks are voluntarily on their own, okay, parking their excess reserve with the Federal Reserve rather than to lend it up to their peers. Okay, so this is slightly different. Okay, how do we use the open interest data of futures options? Does it give any clue for trading? Obviously, yes. For those who are into trading, and of course, the volume of open interest do play a role. Okay, it's very different from OTC product. For example, you trade CFD, for example, let's say you trade spot gold. There is no open interest because there is no official number for those. Only you can get these official numbers like open interest and volume from a regulated exchange traded environment. If the product is traded in an organized exchange, yes, all the volume will be captured. Okay, because in the OTC market, it is not transparent. Nobody knows which counterparty is holding how much long and how much short. So that number cannot be collated. Okay, so where it's very different from organized exchange. Yes, there are people who use that as a basis to decide whether the market is firm or not firm, or whether to buy or to sell. Yes, it is definitely something that they use. Okay, so now, not to stuck here for too long, let's continue. Let me see, where am I now? Today the interface looks very familiar. Okay, now we go into, do you want to go into UK? Because we are already at 10 o'clock. Is it 10 o'clock? I think we are already quite late. We're already at 9:20. Okay, let's continue. Now, earlier on, I did mention that the European equity index is charging away. You can see this at 7,864 in the FTSE 100, which is the UK equity index. It is on steroid. It has already taken out my projected target at 7,681.17. So now, where is this number relative to the all-time high? This is the all-time high, 7,303, which is traded, I think, in May or March 2018. So that is 4 or 5 years back. Okay, so now the market is challenging these levels. So when you look at the GDP numbers and talks about inflation, inflation still raging away in the UK, and the GDP numbers are not good, the PMI numbers are looking horrible, how can they justify such a valuation? Okay, so I am a little bit curious as to how Europe equity prices are so high relative to the US equity prices. Okay, if you are comfortable chasing this market, then you should be buying. Okay, technically this market is very bullish. There is no sign of any weakness at all based on what I can see. Okay, but at the back of my mind is that it doesn't seem right. Okay, the fundamental doesn't seem to gel in with what I'm seeing on the chart here. Of course, I can depend on my chart and say, forget about the fundamental, just buy. Okay, but something is nagging me. I am not prepared to buy this index here because I know the fundamental is less than stellar. Okay, so you can decide on your own whether you want to continue to stay bullish on European equities. But from the technical outlook, it does looks to be very, very firm. Okay, if the market take out 7,903.5 in the coming week, it will be at an all-time high. Tell me what justify all-time high prices in equity markets in the UK. I cannot find one reason, not even a shred of a reason. Okay, so I am very, very concerned about this continued push higher. Okay, maybe this market is super overvalued. So if the market do turn around, maybe this will be my weapon of choice. Okay, instead of selling the Nasdaq 100, maybe I will start looking to sell the very, very rich European equity index. Okay, now the other one, of course, is the DAX. DAX is, of course, the German index. It is nowhere near as bullish as the FTSE 100, okay, but it is still very, very high. In fact, it's already challenging the next possible level, which is this last year January high, okay, at 16,285. It is already beyond the March high, the last March high. Now it's definitely gunning for this level here, okay, 16,285. Right now, where it is right now, at 15,100. Is it far away? Not that far away. Of course, the nearby target for me, the dominant trend target here is 15,317 in the cash index. Where it was traded at a high this week is 15,132. Again, not very, very far away. Okay, it's just achievable to hit this target. Okay, but whether it has enough momentum to go all the way to challenge the last year high, and that is something we have to watch. Okay, I'll be very curious. Now, over in Hong Kong, of course, the dynamics are very, very different. The reopening of the Chinese-Hong Kong border is the only thing holding up the Hong Kong market right now. Okay. After being deprived of a major influx of tourists from mainland China, Hong Kong has not been doing very well. In fact, if you look even further back to 2019, we have the student protest, which has been very violent, very destructive, and then followed by the US-China trade war that spilled over into Hong Kong, and then everything that Hong Kong produced and export to the United States, US say that it must be rebranded as made in China, not made in Hong Kong. So that is a subtle difference, but it will impact the trade flow between Hong Kong and the United States. And then, of course, after that, shortly after, we have the COVID lockdown. And for China and Hong Kong, it has been locked down the longest. Okay, so it has done a lot of damage to the Hong Kong economy. So now that this border has reopened, there's a lot of expectation. If we can claw back 50% of those growth, even before the student protest, there's going to be a lot of upside. So the market has been going up. But by and large, if you look at the technical, this market is severely in a bear market. Okay, it has been in a bear market since February of 2021. Okay, so we are in that 2-year bear market. Okay, so now we are beginning to see some kind of light at the end of the tunnel. Whether this can be enough to get Hong Kong out of the bear markets, I think it's still premature to make the conclusion. Okay, if the world started to sleep, okay, US equity started to sleep and goes back down very sharply, obviously Hong Kong market cannot go up in any significant manner. Okay, so again, this is a reactionary market, but right now everything seems to be lovey-dovey because the expectation of influx of Chinese consumer into Hong Kong, okay, is going to be the catalyst for extended rally in the Hang Seng Index. Okay, currently the target for this Hang Seng Index in the cash market is at 22,118, and where we were at the high this week itself on Friday is 21,770. So it's not that far away. It's definitely achievable. Of course, this will be a mountain to climb. The April and the June high last year, 22,500 is going to be a mountain to climb. Okay, we can see that in June of last year, it did not quite make it. So this time around, can it make it above 22,500? We will have to see. Okay. Now over in the Shanghai Composite Index, we can see that it is not as bullish, as what we see in Hong Kong, but it is still going up. Again, this is a market that has been coming down in fits and starts, and the high here was actually last July. Okay, so not as far back as February of 2021 like Hong Kong. Okay, but here you can see that prices, if you can take out the 3,308, okay, it will change the entire look of this Shanghai Composite Index into a bull market. Okay, so based on this, there's a good chance because it does look like a larger degree three wave. Okay, if this is a larger degree three wave, then this higher at 3,424, which was last registered in July last year, will be taken up. Okay, based on the structure of this potential three wave rebound. Okay, so we have to see how things pans out. Now, the one that is actually not doing fantastically well is this one. Okay, now the theme has been, what is the impact of the Bank of Japan allowing the bond yields to go up? It means allowing interest rates to go up. Higher interest rate is always a negative for equity markets. So as the world is buying yen in expectation of the Bank of Japan doing away with negative interest rates, and perhaps the sentiment for higher interest rates may actually be at play right now. Okay, but that is working out in a different manner for equity markets, especially in the Nikkei 225. Just understand, higher interest rate is going to cost the cost of servicing the national debt so much more prohibitive. Okay, and Japan right now is not in that position. Okay, on the one hand, there is big change in the geopolitics. Okay, Japan has increased the defense budget tremendously just to get ready for further problems with China, okay, and even North Korea. So you see that on the one hand, they have to spend massively on defense, okay, and their defense posture seems to be changing from a purely defensive play. Now the Japanese defense force wants to be a force in which they can project, their power. They used to have only weapons for defensive use, but right now they think they are acquiring weapon systems that can actually be of a more aggressive targeting mode. Okay, so if they're going to spend more on defense, the budget is going to be constrained. Okay, and if the yen continue to be weakened, there is very little they can do, because if your currency is weak, everything that component materials that you need to bring in to, whether it's for defense to build your defense equipment or to resuscitate the economy, it's going to be very prohibitive. So they need, on the one hand, a stronger yen, which is they're currently getting. Okay, but a stronger yen means higher interest rates. On the other hand, the servicing of that mountains of national debt is going to be a big problem. So between two very bad choices. Okay, on the one hand, you have China breathing down the neck. Next, North Korea is not exactly the most friendly nation in the East China Sea. Okay, and then on the other one hand, they need to resuscitate the economy. The economy is dying. By looking at the Nikkei, we can see that this Nikkei has been down and down and down since when? Since September last year. Okay, so the new low was actually last year. The start of the new bear trend was started in September last year, and it has, until this week, market has actually been going down. Okay, this week we have seen a bit of a rebound. Okay, now, but on Friday you can see prices come back down again. Okay, in one day it lost 50% of its most recent rally from 25,630 to 26,547. In one day, they lost 50% of the most recent gain. So this is definitely not a good picture as far as the Japanese equity market is concerned. They are very concerned with the possibility this coming week, the Bank of Japan is going to decide on interest rate. They're not so worried about the interest rates being a bump up. Okay, of course, there is the possibility they will completely do away with the negative 0.1% interest rates, because Kuroda is stepping down in April. He only have 3 more months to go before he reverse some of his policy. Because if this policy don't get reversed and the new governor of Bank of Japan comes in and he reverses everything, that will look very bad on him. Okay, so he needs to normalize his monetary policy before he call it a day. Okay, so I think time is working against him, and he definitely want to normalize, at least get out of the negative interest rate environment. Okay, right now it's only negative 0.1. It's not that difficult to move to 0 or even to 0.1 positive. Okay, so we have to watch that front, but higher interest rate is definitely negative for the Japanese equity markets. Okay, do understand this dynamic over here. Let me check if you got any question for me. Okay, the question here is when people start buying, the price should go up, but why it goes down always immediately after purchase for many people? Are you referring to what any particular product? Who is this person? RC. RC is Raja Kumar. You see, that this is the oldest trick in the game. Okay, whenever, just imagine if you want something to go up, and if you already have interest right now, like I mentioned earlier on, this last few months, we have very important personality telling us recession is coming. Okay, even the bank, the World Bank, the IMF is telling us the likelihood of a global recession has increased. So they are feeding us with something very, very negative. Okay, unconsciously we will build that into our decision making, thinking that I'm not going to buy. Okay, I'm not going to buy because things are going to get bad. Okay, so that could be a self-fulfilling prophecy over time. But because you already have planted the negative thought, as we look at the Dow Jones go up, we'll say, I'm not going to buy because recession is coming. So you can see that in reality, the perception that we have been fed will lead us to have a different conclusion. Okay, and once we have that conclusion made in our mind, and then we see something very different that's happening in front of our eyes, we will like hesitate because it is in contrast to the scenario that we've been painted. Okay, so always be aware that there will be interested people who try to influence our decision making. That's not only for government officials. Even in the stock market, sometimes it's very convenient for analysts to be paid off, okay, to write something rosy about a company, a particular counter, and everybody look at this report, oh, so rosy, I want to go and buy. It's exactly one we are bought in, the price flip over. Has it not happened before? Anybody who have traded equities would have the same feeling at some point in their career. Okay, now yeah, in general. Okay, let's continue. Okay, we want to go into stock currency. Okay, I would have loved to spend some time with regional equities, but I think time is a bit of a constraint. I'll go straight into dollar. Dollar index. You see, dollar index has peaked sometime in September last year. In fact, what was the exact date? September 23rd, almost towards the end of September, and it has been coming down. And this price comes down has been very sustained and has actually gained speed. Okay. So much so that right now it's already challenging the last May low. Okay, 101.30. We're not that far away. This market closed at 102.18 on Friday. Okay, so based on this structure, you can see that there's only one color, pink. To me, that is bearish, and this is the daily time frame. That means the medium term, the dollar will continue if it's expressed as a dollar index. But this dollar index, you can understand, is not a well-constructed basket of index because it's skewed towards the euro dollar. So I look at it as it is just the reverse image of the euro dollar. Okay, so because the basket is more than 50% are actually based on the price of euro with the currency. Okay, and then of course we have the pound, we have the Japanese yen. Okay, and then the Canadian dollars. Okay, but it's not a representative index. So, but purely just to look at it as a dollar index as it has been named, then the dollar is definitely not doing well right now. Okay, in fact, there is every possibility that it will continue to drop down to the 100 levels. Okay, my project target free based on this is 100. Okay, so when you get there, based on what we are seeing so far, it does look like there is a very good possibility it will continue to slide. Okay, but over the longer term is how long? What about 2024? Or what about the second half of this year? Dollar currently is coming down. Okay. Now you have to understand when you piece this reality here with what was mentioned just a couple of months back. Remember, the Bank of International Settlements came up with one major headline: 65 billions of FX swap. Okay, is very gray, and it is a silent killer. What it means is that because the Federal Reserve has been hiking interest rates up, the dollar has been on steroid for a good part of 2022, okay? And because the dollar has been going up, all other currency has been falling. We're not just talking about emerging countries, emerging currencies, okay? We're talking about major currencies, the sterling pound, the euro, the yen, okay? And that is causing a shortage of dollar outside of America. Now, the dollar is a reserve currency, okay? It is traded not only within the boundaries of the United States, it is also traded outside of the United States because the rest of the world is trading with the US, and most of the commodities, anything that is internationally priced is priced in dollar. And as the dollar goes up and their own currency comes down, companies, especially American companies that's operating outside of America, they are earning foreign currencies, but this money need to be repatriated to the US, okay? So even American companies that's operating outside of America is in need of dollars, and there is simply not enough dollars circulating outside of the United States. That caused the FX swap, okay, to be all stressed up because everybody is bidding up the dollar outside of America, okay? So in a FX swap is very simple, right? Central banks like the Swiss National Bank has an arrangement with the Federal Reserve. So if the Federal Reserve wants to save the Swiss National Bank, they cannot bail out the Swiss National Bank because the law doesn't allow them. But what they can do is, I swap currency with you. Okay, you give me Swiss franc, I give you dollar, and then at an agreed point, we will reverse that transaction, and then I return back the Swiss franc to you, and I take back my dollar. But in the meantime, I charge you a small interest. But for example, the Swiss franc is falling in value relative to the dollar, you'll find that for the Swiss National Bank, it's a losing trade. Okay, because the currency is falling as the days goes by before they have to reverse the trade. So this is just to give an example. And a lot of people go through the Swiss National Bank to acquire dollar because they know the Swiss National Bank has this FX swap going on with the Federal Reserve. So that is what we call the over-counter derivative FX swap. It's just not just an FX swap. We have commodity swaps. We have all kind of swap, interest rate swaps that has gone chaotic because the dollar has been going up, interest rate has been going up in the States. So this is creating a negative. So the World Bank has actually warned the Federal Reserve, slow down the interest rate hike. I think you have to listen. It's no coincidence that the dollar has come down since then. So when you put one and one together, the World Bank is telling the Federal Reserve, you want to stop the dollar from going up higher because there is a serious shortage of dollar, and that's causing a lot of stress in the credit market. Okay. Earlier on, I did mention, right, there's this reverse repo going on. American banks are definitely not going to loan out to European bank because they don't trust the European bank being solvent by tomorrow morning. Okay, so they are not even looking to loan out to their own peers within the US banking system. So any banks that have excess reserve will rather park the money with the Federal Reserve because it's safe. Okay, and that is causing a knock-on effect in the credit market. The dollar come down has got everything to do with the World Bank warning the Federal Reserve. At the rate you high interest rate, the dollar is sucking up all the other capital in the markets, and it's causing a big problem. Okay, and this is something that I think instead of worrying about recession has nothing to be. In fact, the world do not have to worry too much about recession. Now, recession is part of the business cycle. Business cycles consist of boom and bust. Okay, eventually recession will work its way out. Okay, but if you try to prevent a recession from happening, you're only going to prolong the pain. Okay, what we are more concerned is that this attempt to avoid a recession or to control inflation is leading to all kind of other complications. Okay, and it's causing a lot of stress in the credit market. It's causing a lot of stress in the pension fund. Pension funds are dying. They're basically bankrupt. Okay, so if pension fund bankrupt, which we have saw a version of it, okay, last year when the UK mini budget caused a unraveling of the UK gilt market. So this could be magnified many times over. It is happening worldwide. Okay, so this is where the real danger is, not the recession that we've been told. Okay, it's the credit market cracking up, okay, because that market is 1,000 trillion, a quadrillion market, you know, it's so big, okay. So this is the bigger danger. Do watch out for that. Okay, for dollar versus the yen, we can see dollar yen has also been coming down, mimicking what we see in the dollar index, okay. And you can see this week itself, the dollar continued to trade lower. Now remember, before this week, it was at 129.5. And I mentioned many times during my daily market update, or you guys may not know that I have a daily market update. Okay, in my daily market update, I do mention there is a possibility the market will take out 129.5, and it did. This week it went up to 127.45. Okay, and it does look like it will continue to trade lower. We are already near the last May low of 126.36. This low looks like it may or may not. It may not be a whole, okay? But anyway, I have a target at 123.35, okay, for at least this run, okay? You can see the prices of dollar versus the yen is exactly what I mentioned. The carry trade is unwinding. People now are looking towards Japan, okay, to allow interest rate to go up. That's why they are buying yen, okay? And this is exactly what's happening in the currency market here. Euro versus dollar. Euro, of course, has been charging along much more aggressively than the sterling, and it has already taken out the last March high. Now, dollar yen has not even challenged the last March low, but the euro versus the dollar is already trading above the last March high, against 1.0787. So the high traded this week is a 108.68, which is on Friday itself. Now, notice that this rising channel here, the market is just hovering just below the midpoint of this channel. And if this channel is going to be relevant, the midpoint sometimes can act as a resistance. In this case, market is going up, it can act as a resistance. Even if you punch beyond that midpoint level is going to act as a running support. Okay, so for the time being, there's every chance the euro versus the dollar may go up to 110, okay, 1.10. So this is a very nice round number. Be careful about this number here. Okay, 1.10 is a very nice round number. Even at parity, we have already gone beyond parity. The next number significantly is this number, 1.10. Do not chase this market beyond this level if market manage to go up to 1.10, okay, because there is every possibility it will start to unravel. Okay, remember, the economy in the eurozone is terrible. I have no faith that this currency will be in existence 10 years from now. Okay, so I'm not going to buy this currency. I also won't buy. Okay, I'm looking for that reversal to happen. Once this momentum freezer out and the markets give me a more conclusive reversal signal, I'm going to sell this currency. I'm going to hold it for at least the medium to long term, okay, because there is every risk this currency may actually implode and be part of history. Okay, now sterling has also been going, this is Aussie. The Aussie has also been going up, benefiting on the back of a weaker dollar. So we can see that the numbers coming out from Australia this week itself, whether it is new employment, new jobs being created, this coming week, they do expect a lesser job being created. Of course, the trade balance has actually improved. Remember earlier on at the beginning of this presentation, the final number released for last month was actually a lot better, 13-point-something billion dollars against expectation of 12-point-something billion. So you can see this is actually working out well for the Aussie dollars. Okay, for the time being, I can only say that this rebound from 0.61 is a counter trend. Now, when you consider the reopening of China, that's going to be beneficial for Australia. There's a lot of scope for this currency to actually go up, because China buys traditionally a lot from Australia. It is only during the last Morrison leadership in which the Chinese-Australian relationship has gone from bad to worse. Okay, now there's a new prime minister in place, and it seems to be he is not as anti-China. Okay, he is prepared to talk to China, and that has actually taken the stress and between these two countries. Okay, so if China opens up and they are willing to buy from Australia, it's definitely going to be good for Australia. Okay, so there's possibility that Australia will outperform, the Aussie dollars may outperform the other currency this year. Okay, purely on the China play. Now, when we look at sterling, sterling is also going up, but you can see that it has not gone up. You see now, the euro dollar has already traded beyond the last May high. We are talking about a currency pair that has not even managed to take out the last month high, which is the December high of 124. So based on euro and the sterling, if you had to pick one, okay, I think this one is definitely looking to be very weak. Okay, even the same case is happening. We have this rising channel here, and the prices has been hovering below the midpoint of this rising channel. Again, it's acting as some kind of a technical resistance. So do watch out for this rising channel resistance in the midpoint. Okay, so by and large, I do think that the UK economy, based on the currency, is already not strong. Okay, so I won't be buying their FTSE 100. That's for sure. Okay. Now, before we go any further, let me see if you got any question for me. Okay, Sky FX. Now I know that's how the trick works. I think I'm going long for gold at 1900. Okay, we will talk about gold later on. Okay, it is something that I have always been banging my head. I have not bought more. Okay, in fact, I currently have no holding long position in gold. I'm actually kicking myself. Okay, now Ranjit Kumar is asking, is the future CME market also closed on holidays? They usually operate 23 hours a day, I believe. Yes. The regular market will be closed, but in the early morning hours, obviously the Globex will be turned on. The electronic trading system will be turned on. So yes, if you are referring to that, yes, it will be open, but the regular trading hours will be closed tomorrow for US exchanges. Now let's go to crude oil. Now crude oil is something very interesting because I did mention throughout the entire week itself, even last Sunday, I remember I mentioned January 11, in which I expect energy prices, especially crude oil, to stabilize and reverse, and it did. Okay, the market actually went up on January 11. This is one big bar here. Okay? This long bar here was January 11. Okay, so the market actually went up for 3 days in a row. So maybe there's a possibility $70 could be the low for this round. Now remember, the US strategic reserve has not been filled up yet. They have always wanted to buy below $70 or $70 and below, but I think they have missed the boat. The current price of crude oil is hovering just under $80 per barrel. Okay, and then with China opening up, China is going to buy more energy or expected to buy more energy products. So maybe the $70 is already the low. Okay, so if that's the case, we can expect higher energy prices immediately. I think it will try to take out the $83. Okay, and we'll see how far it can go. But there's a possibility that $70 is already the low for this run. So there's a lot of upside potential. Okay, and as an icing on the cake, all we need now in the escalation of war in Ukraine. Now, I'm not black-hearted, but what I'm saying is there's another negative input. It will cause energy prices to go up even more. Okay. Now, the only outliner is natural gas. Natural gas looks like it has stabilized, but on Friday it closed back down again, which is quite a shame because I was looking for the natural gas prices to find a bottom, and I thought it could, if it only can close, let's say above this price of $3.72, then the market will look good on a weekly basis for a reversal. But the reversal did not come. Now let's look at the weekly time frame for the natural gas. Natural gas low here. Let me see, where is this price? $3.53. So this is the low for last December. The market pick up the December 2021. Okay, so this is a 2-year. This is more than a 1-year low. So the market has taken up this level, and it's still continuing to fall. Will it go down below $3? At the rate it is falling, I would not say it is impossible. Okay, so obviously the bottom that I'm hoping to see did not quite happen, because this low here on the weekly time frame is going to be very crucial, because now the price has taken out this low here at $3.53. Okay, then the market looks like it probably will hunt for lower levels before it stabilizes. But if the market turn around from here, at least to close this week, okay, this week, there's still the possibility the market does close below above $3.72 at the end of this coming week, then we may see a reversal. Remember, this is a new period. okay? And if it doesn't happen at the end of January, let's see whether February, the first week of February, will cause a reversal. The fundamentals is slightly to work to the upside, okay? So right now the market is definitely coming down, right, big time, okay? So this is bearish for time being, but we will see how things perform as we go into the end of this coming week, okay? Let me check if there's any question for me. How to calculate $3.72 based on the price? I'm not calculating anything here. Now, this is the daily time frame. This is the weekly time frame. Now, let me expand the chart for you. This closing here, okay, which is the previous week, okay? The previous week, the low here is $3.71. Now, if you look at this number over here, okay, it's moving as I move my cursor. You can see there's an open, high, low, close, right? Okay, the close is $3.71. So I only need market to close above $3.71, just above by 1 cent. Okay, that will tell me that something else is happening. There is a possibility market may find a bottom as it closes higher. If it does that, that will be what we call how do I call? Now the market, you see, when you trade technical, okay, sometimes the market will try to lure in to take a new position as the market break new low. Then as market break new low, what naturally will happen? It will attract new sellers into the market. But these sellers are what we consider weak hand because they sell ever lower prices. The flip side can also happen as the market goes up, okay, it will encourage more people to chase this market on the way up by buying near the high, okay? So if you have committed, imagine if this market is coming down, I'm talking about this natural gas right now. Natural gas is coming down and it has broken new low on a weekly basis. Okay, every week you have a new low. Then suddenly 1 week it closed above the closing price of the previous week. Don't you think something else is happening? That will be my first clue that perhaps a reversal has taken place. Okay, so I'm using sign like this. It must be a significant bottom or a significant top. In this case, this bottom here was registered in December 2021. So this is a significant low here. So the price, yes, it has gone under this week. But what if next week we have another reversal, the cost price to go above the closing price of the previous week or the low of the previous week? Okay, if you want to be safe, look at the closing. The closing will be $3.71. Okay, the lowest you ever traded was $3.52. So again, use that as the timing device. I can use this as a timing device. Remember, week to week, month to month, day to day is a new period. And new period sometimes give us an opportunity to get in on the reversal early. Okay. I hope you can understand my my thinking here. Okay, because the market continuously to do a fake move. Okay, and now the World Cup has recently been over. You saw how these professional footballers, okay, they may feint the body to one side, but they actually want to move the other side. Okay, you saw that in Cristiano Ronaldo. You saw that in Messi. You see, these people are professional. They will do a body move, and then if you are a defender, you try to check their move, and then they make their body move one side. You also follow, and then almost immediately they will swing to the other side and then bypass you. It is the same thing that we are seeing in equity in financial markets. They do a forced move to cause you to commit, and then they go the other way. Okay, this is called a fake move. It happens in basketball. It happens in any kind of ball game. Okay, so sometimes when you are watching games like this, you can actually relate them to this to financial markets because human being will always find an advantage to work. I hope this is enough to give you an analogy. Okay, I hope it's a good analogy. Okay, right. Let's continue. Now over in
Thank you, Daniel.
Gold market. Gold market this week has been on steroid. Okay, this is. Let me see. I'll show you the date. This no, it's that's my gold. Yeah, gold is here. So this is gold market. This is on the daily time frame. Oh, sorry, this is weekly. I'll show you the daily. So gold market has actually been going up and very aggressively too. You can see this Friday, the prices went up even further. At $1,800, I was already not willing to buy. but the market went up another $121. So what to do? Okay, so I can only patiently wait. Okay, you need to buy precious metals. Okay, now I'm not talking about trading. I'm talking about owning the physical assets, because something is happening. If China buy 300 tons of gold, something big is happening. One is that they are trying to get out of the US dollar system. They have so much holding on US Treasury. They need to sell that. And then to sell that, to buy their own currency, they will cause their own RMB to go up, which they do not want to. Okay. So the next best thing is to buy something neutral, take the proceeds from the sales of the US Treasury, go and buy gold. Okay. And then gold over time can be an anchor to the RMB. Okay. Because the world is going to de-dollarize. We are already seeing for the last few months, the world is so scared of the United States weaponizing not only the dollar, they are very scared of them weaponizing the entire monetary system, including the World Bank, including IMF, including SWIFT. Okay, the world has seen what the Americans will do just to pursue an objective. Okay, so the world is worried. They're trying to get out of the dollar system, but it cannot happen overnight. Okay, so over time, gold is going to be the basis of a new currency system. I'm not saying that we are going to go back to the gold standard, because the gold standard has proven to be totally not flexible enough for modern finance. Okay, so we are not going back to a gold, we call it a gold standard. Okay, but commodities is going to be the anchor for future currency. The Western currency system is based on debt. And now the debt has come to the point whereby it is totally unsustainable. Nobody trusts them to pay back whatever they borrow. Okay, so the debt-based currency system, the fiat system that we have known since Second World War, is coming to an end. Okay, so a new currency system need to be devised. Okay, the BRICS nation are leading the way to develop an alternative to the debt-based currency system. Okay, so it definitely will be based on something of a commodity. Russia have oil. Okay, China imports a lot of oil from Russia. Okay, so they need to have some kind of medium of exchange. They're not going to base it on dollars anymore. Okay, last year we saw between Russia and China, their two-way trades has been based on rubles and RMB. Okay, so for people to want to get on board this alternate monetary system based on some real assets, okay, then gold could be one of the mix here. Okay, and like I said earlier on, there is this possibility China is stocking up on gold in preparation for a head-on collision with the United States. Okay, so something big is happening, something titanic has shifted, and the current system of debt-based currency is going to see the end of the move. Okay, and that means over time the dollar significance will be reduced. It will not go away completely, okay, but it will be seriously be reduced, because the world is no longer wanting to price their products based on dollar. Okay, so this is the sea change. You want to hold on to precious metals, okay, physical. Okay, so the question is that where can you buy? Go to the jewelry shop. Not jewelry shop. The last place you want to go is jewelry shop. Go to the bullion stores. Okay, I'm not sure where you're from, but if you're in Malaysia, Singapore, you can easily go to a physical bullion store. Of course, you do your due diligence, and then you buy, and then you hold. Okay, because this will be the currency, not so much to make money. You need gold and silver to preserve your purchasing power. Okay. It is the reality. Now, if you look at gold prices or silver prices based on price in dollar, this is exactly what you see. But you got to do it based on your local currency. If you are Malaysian, look at the price of gold price in ringgit. For Singaporeans, you want to look at gold market based on Sing dollars. It has been a lot more stable in terms of your purchasing powers. They are not as volatile as those priced in the US dollars. Okay, so look at it from your own domestic currency perspective. You will find that gold is definitely able to preserve your purchasing power. You need gold to survive the coming future, not so much to make money. Okay, you need it. Okay, and of course, for traders, you can buy gold, okay? And I have always mentioned there's a physical tightness in the cash market in London. So people are pivoting to COMEX, buy the futures contract, hold to expiration, and then demand delivery. And this is exactly what happened, okay? Now, silver market is also seeing the same thing. Silver market has lagged gold this round, but it's only temporary. You can see Friday gold, silver prices has broke through and it's already trading at $24, almost 30 cents. And it will take out the $24.55 in no time. And the market is going to go and challenge either the April high or the March high, okay? And you can notice that this market has no pink color. It's only green color. So this is a lot more bullish relative to gold market. Gold market only started to go up in November last year, but silver market has actually bottoms up in September, 2 months before gold bottoms out, and it is leading the way up. Yes, over the last 2 weeks, it has been lagging behind gold, but it will over time catch up and overtake gold, okay? So if you have to choose between the two, pick silver, okay? But for investor, you want to hold both, okay? Because gold, you cannot spend gold in that sense, okay? But silver coin you can spend, okay? If the day should come, okay, where the whole world paper money system collapse altogether, then if you need to survive in the modern society and you need some kind of exchange to get what you want, then it's more practical to use your silver coins to get what you want, okay? You don't want to cut down your silver bar, your gold bar to get your net day-to-day expenditure. There would come a day whereby this very unlikely scenario may come into play, okay? Just don't be caught flat-footed, okay? I do encourage you to go out and buy physical, okay? Let's see if there's any question. Look, I watched some theory and they are telling that peso currency will backed by gold in that. Is that true? Who is this person? This is SkyFX. I have no idea how the, I'm assuming you're talking about the Philippine peso, or is it the, what kind of peso? If you're talking about Philippine peso, I have no understanding of peso, so I cannot comment on that, okay? Now, Raja Kumar said how long it takes to replace dollar with RMB. It will not replace. The RMB will not be able to replace the dollar because the Chinese do not have a working capital markets. Okay, they do not have a bond market in which to recycle the reserve. So I'm not saying here that the RMB will replace the dollar. It will not. Okay, a new currency system will evolve over time, but it will not be the RMB replacing the dollar. Okay, I don't think that RMB wants to replace the dollar. Okay, that means that people, it will cause the demand for RMB to go up, and I don't think China wants that, because China is at the end of the day still a major exporting nation. To have your currency so strong, it will impact their external trade. Okay, so I don't think that that's objective here. Okay, forget about the narrative about RMB taking over the dollars. This is what the American has been talking about. Oh, the Chinese are coming in to kill off our dollar, so they are the enemy. China have no intention of replacing the dollar. Okay. Will it be within 5 years or more than 10 years? You know, again, this is a moot point here. I don't think it will be replacing the dollar anytime soon. Okay. How about gold mine? Can we buy gold mine? Yes, you can. Another play on gold, if you're looking for capital gain, purely from the capital gain perspective and not so much as preserving your purchasing power, yes, you can actually move into mining stocks. Okay. But be very careful. Don't buy the junior, buy the seniors. Okay, I mean the big boys, the BHP for example. So those are the big boys you want to hold on, because the minor shares, it may give you a lot more upside, but they are definitely more volatile. Now, I don't do equities per se, so I cannot give you more specific, but you can consider gold mining shares, but you do not want to touch the ETF, because the ETF is a derivative of a derivative that's based on nothing but paper. Okay, it's the biggest Ponzi you can ever find. Okay, so I never trust ETF because they have nothing. Okay, because they don't have allocated gold or silver within their ETF itself. Now, okay, let's continue. We are almost at the end. Crypto. You can see the crypto this weekend has also been going up. Yesterday, I checked, the market was above 21,000, I was stunned. Okay, because I don't expect this move. But you can see that the maybe I can show you the 4 hours. This market is up and away. Okay, on the 4 hours, you can see this is an accelerated move. It has taken out this resistance here. I got to cancel it because the resistance is not going to come back anytime soon. Now we have a series of more and more acute support line. Okay, and this is very acute. To break this, it may not mean anything. Now the thing is that the market has gone up 21,229. On what basis? Now, a lot of people is betting against the Federal Reserve, thinking that at some point they will have to pivot, meaning to cut interest rates. Now, if you look back in history, the big collapse in crypto markets happened when the Federal Reserve hiked rates. At about the same time, you can see prices of cryptocurrency across the board all started to fall big time. Now the talk is the Federal Reserve, based on the latest economic numbers, based on last Friday non-farm payroll, based on this week Thursday CPI numbers, people are seeing evidence, okay, that inflation is coming down. So the Federal Reserve may not have the reason to continue to hike rates at the way it did last year. So now the world is thinking at some point the US economy will go into a recession, and if that's the case, then the Federal Reserve will cut rate, and that is definitely bullish for all risky assets, including stock market, including crypto markets. So this market here has gone up. I think based on the bet, the Federal Reserve will have to pivot, and this is a very serious assumption, because even if the Federal Reserve stop hiking rates as aggressive as they did last year, they may slow down, but it is still inching higher. Now, assuming come February the 1st, the Federal Reserve high interest rate by 0.25, which is a lot lower than the previous month of 0.5. But it's still up nonetheless, right? And the Federal Reserve chairman said it's going to be higher for longer. So the Federal Reserve now have a reputation to protect. Remember, they missed the inflation story big time. Towards the last quarter of 2021, they're telling us inflation is transitory. It means they were behind the curve. It's only in the first quarter of last year they decided, oh, prices is no longer transitory. It's getting serious. That's when they start to hike rates. Now they want to keep the rates high, and they are not about to do a policy reversal at the first sign of problem in the economy, okay? Because that will totally destroy the credibility. The credibility is already been questioned by the market players. You tell me inflation is temporary, but it's not. Then you started to take action and then cause interest rate to go up. Now, at the first sign of a recession or slowdown in economic growth, you want to reverse the policy and cut interest rates. Then the Federal Reserve, whatever they say next time, will have nobody will believe them anymore. So just from the credibility perspective, the Federal Reserve, even if they realize that they have high interest rate for too high, okay, they cannot do an immediate reversal. I don't think they will, okay. I think that is my understanding of how the big ego works, okay. If you're a Federal Reserve, you're the most powerful central bank in the world. The whole world is looking to you for the next move, okay? And then if you do U-turn like this so frequent, who dare to follow you, okay? So from that perspective, even though if the US economy starts to slow down, the impact, the possibility of a sudden reversal in interest rates, in terms of monetary policy, it's not going to be immediate. It will be at least 6 months before they actually act on it. You see, at the current rate, I think they have really hit their maximum rate, but they may not realize it. Okay, they say that they're going to get the terminal rate somewhere between 5 and 5.5. Okay, right now it's 4.25, 4.5. That means to say, based on their timetable, they have room to hike interest rate by another full percentage more. But the market cannot stand a 5% interest rates because it's simply too expensive. Okay, so I think at the back of the head, they know the economy cannot support anything northward of 5%. God forbid 6%, because the economy cannot take it. Okay, so but they are not about to do a sudden U-turn. because it will look really, really bad. Okay, so if the crypto market has gone up based on this reasoning of a potential pivot by the Federal Reserve, I think they are betting on the wrong horse. Okay, but for now it does looks very good. Okay, because this is a 4 hours time frame. The overall the overall picture for the crypto market, if you look at the weekly time frame, this is a bear market, seriously bear market. Okay, and this is okay, like you cannot see too much information here, but by and large you can see that this is actually a small recovery from a very low end. Okay, the lowest it went to was 13,000 what 13,470 something. Okay, so the market has gone up, okay, to 21,000, almost 300, okay, $250. So you can say that this is a reversal. Okay, it can be a reversal because this one looks like a cup and handle, right? Okay, bottom, rounding bottom. Okay, but the immediate challenge will be to take out a 21,484, which is the immediate target that they need to cross beyond, which is November high. Okay, even then they're going to go to September high, and then the one that will really decide whether this market can actually reverse is the 25,200. You will have to take out a lot more levels to actually convince the market that it has actually turned the corner. Okay, by and large, this is still within a bear market over the longer term. Okay, Ethereum also, of course, has benefited. Okay, so it went up to almost $1,600, and again, you can see the support line has become very acute. It used to be 45 degrees, and then it started to go. This is 15 degrees, very unstable. Okay, so of course today we do not have new follow through buying, but on Saturday we can see market trading at almost 1,600. Okay, immediate target 16,074. Okay, so this will be my target is 16,061 and a half. So again, we will have to see whether it has enough momentum to go up. Again, this is a very bearish market. You can see the larger picture is all pink in color. So this is a very small blip, okay, to the upside. And Ripple. Now, again, of late, we can see that there's a lot of commentary saying the lawsuit between the SEC and Ripple is coming to a conclusion very soon. And the sooner the conclusion is established, the better it is, because Ripple has been waiting for a verdict all this year without able to move anywhere. So it's basically holding water. If the verdict is a positive one in favor of Ripple Lab, this market will take off, because the only thing that's capping this token, the price of this token, has been the possible negative outcome of the verdict. Okay, but the judge is not ruling as yet. So by the date of getting a verdict is getting increasingly possible, because a lot of analysts are again talking about an early resolution. Okay, so hopefully something big will happen in Ripple. But for the time being, but this blockchain, the blockchain based on Ripple has actual utility. A lot of banks use their blockchain for settlements. Okay, so it has actual value. So if compare this to other crypto tokens or coins, I would think this Ripple technology is going to be with us for quite some time, you know. Okay, so it's not just a speculative instrument, it's actually one in which it has real life application in the banking system. I know DBS use them, okay, so for their back office trade settlement. So this is a technology that is actually have real life application. Okay, now Binance coins have actually gone up again, but again, this is a speculative token issued by the Binance exchange. Now, Binance, as you all know, has been accused of money laundering by the US Department of Justice. So that is definitely a negative. So this price goes up is more or less a reaction of the general buoyancy seen in the crypto space. Okay, rising tide lift all ships. Okay, so maybe this is the case here. Okay, now Dogecoin, again, I do not want to speculate on this coin. This coin has no practical use. It is a meme coin favored by Elon Musk, and the price is just trading under 10 cents. Okay, so again, this is the same story as the Binance coin, whereby I think is rising tide raise all ships. Okay, now the other one that you want to concern with will be this one, Cardano. Cardano has actual practical use because this is the Ethereum killer. Now, Ethereum is a major blockchain. Okay, now so there's a lot of people talking about Cardano being able to challenge the dominance, the dominance of the Ethereum blockchain. So if that's the story, then obviously this one has a lot more utility compared to, let's say, Dogecoins. Okay, so this one maybe in the same category as the Ripple token. Okay, but I'm not sure where is it being used. Okay. Solana has always been under bad press ever since FTX blew up. Okay, FTX uses a lot of NFT, which in turn is depending on this particular coin here, this token here, for NFT. Okay, NFT, if you're not familiar, is what we call non-fungible tokens. Okay, so this Solana is very closely associated with FTX for that relationship to NFT. So of late, you can see the price has been quite firm. Now, while the rest of the market did not go higher on Sunday today, Solana did a marginal high, $25.09. Okay, if you look at the daily time frame, you'll notice that Solana has a marginal high compared to yesterday. So this is one of the very few coins that actually have a marginal high today. So maybe that is the dynamics is a bit different. Okay, maybe the market here has been too oversold because of the implosion of FTX. Okay, the relationship to FTX is not direct; it's by inference because of the relationship with NFT. Okay, so not sure about the real fundamental, but it looks like it's quite stable. Okay, so there you have it. Let me check if you got any last minute question for me. Let me see. Stephen asking, maybe the crypto big rise is due to the big fall of dollars. They have inverse relation. Yes. It's possible. Okay, but I think the market is looking for some kind of pivot by the Federal Reserve. Okay, I think that is my version of the rationale. Okay, Sky FX is saying that's what I'm thinking too, that they have inverse relationship. Raja Kumar said the Fed already mentioned the terminal rate will be 5% or plus. So anyhow, the rise will reach that level just to protect their credibility. The Federal Reserve is telepathing their path. Okay, they are telling the market what to expect. Okay, so the market, at least they have given notice to the market participants, say that, look, when I say interest rate is going to be higher for longer, I have a terminal rate. Right now, the terminal rate is just below, it's about 4.5%. So based on the Federal Reserve, at the most conservative, there's still another 50 basis point more to go to hit 5%. Okay, so they just say that there's a bit more room left. Okay, they may slow down. Okay, but once they hit a terminal rate at 5%, they're going to keep it there for a while. Okay, and that means if nothing else, okay, if we don't get an external shock in the banking system or in the monetary system, then this longer may last throughout 2023. Okay, of course, things happen. Federal Reserve have to react. And what are the two conditions that may cause the Federal Reserve to do a massive U-turn? Okay, one is the US economy really slip into a very severe recession. Now, for fighting inflation, they will have to save the economy. That may cause them to pivot. Okay, but the day of zero interest, I think, will not come back because that creates too much inflation. Now, imagine interest rates at 4.5%. If on the idea that US economy will go into a very severe recession, means a hard landing, and they bring interest rate down to zero. So all the effort they have been doing the whole of 2022 will be for nothing because at zero interest rate, inflation will come flaring back. Okay, so they're not about to bring interest rate back down to zero. So the zero interest rate is not going to come back. Okay, maybe a couple of percentage down. Okay, but not where enough to save the economy. So that's the reason why I say between inflation and recession, we are probably going to get both, which is a stagflation. Okay, right now what we are seeing from last June to this week's CPI number is what we call a disinflation. Okay, inflation is coming back down. Okay. Now the other scenario is something big happening in the war front. Okay, something big happened. Oh no, not necessarily in the war front. The credit crisis that I mentioned, the 65 billion FX swap market that caused a very stressed credit market implodes. Okay, yes, that may cause the Federal Reserve to cut interest rates, but will it go to zero? I seriously doubt. Okay, because it will mean the whole year effort of trying to contain inflation will be for nothing. Okay. Why is the cryptocurrency market working on Saturday? Is more demand for crypto than traditional currency. Now, To call it a cryptocurrency is already a misnomer. It is not a currency because it cannot hold value. Okay, we saw how it boom and bust big time. So to call it even a cryptocurrency is a misnomer to me. So yes, this market is designed to trade 24/7. Okay, there's no reason why market need to close. In a pure laissez-faire market, prices do not take a holiday just because it is an inconvenient weekend. Okay, market needs to close. Now, the way of thinking is that we are moving into a different age. Okay, markets should be continue to do that what I call price discovery 24/7. Okay, so I do agree with that. By the way, okay, to have the market close because it's a weekend has something to do with religion, okay? Because you have suburb, you cannot work, and you need a day of rest as far as most religions concerned, okay? So what's the rationale? Okay, the Muslims and the Christian have a different idea of a weekend. I used to work in Dubai, and Friday is a weekend. Sunday is a working day, okay? For the Christian world, Sunday is a holiday, but Friday is a working day. So what if we have no holidays? Every day is working day. The market should be allowed to fluctuate to discover prices, okay, without the artificial imposition of a holiday. Okay, so at this point, I do agree with the idea of having 24/7 markets. Who is saying, do I still think gold is going back to 1720? I have to be realistic. I think that goal is almost impossible now. Okay, it's already at 1900. To go down to 1720, I think that observation did not pan out for me. I was waiting and waiting, but I have to come down to the realization it's not coming. So I will have to seek for new levels, but I would need the market to tell me, okay, the structure need to develop to a point where I can actually make a calculated guess. Okay, right now I'm not able to give you a level. I don't even know where's the bottom for this one. Okay, I would need the market to reveal the pattern to me over time. Steven asking, is it better to have 24/7 market because it will not have big gaps which bypass your stop loss? Yes, one of my biggest problem why I never trade equity markets and organized exchange is because the market artificially close at the fixed time and then they reopen the next day to reflect the new reality. And that if there's something in between that happens before the market opens, then the price discovery cannot function, and I would have to bear with the possibility of a big price gap, either in my favor or worse against me, okay, in which I cannot participate. So I hate market that closes and then open with a gap the next day. Equity market always do that, okay? Any kind of national equity markets have opening hours and closing hours. It's not 24 hours, okay? And maybe if you trade the equity futures, index futures, maybe you can get 23 hours of trading, but still we do not have the luxury of it covering the weekend. I hate market the gaps, okay? Because gaps actually increase my overall risk, okay? I don't like market the gaps, okay? And that can only happen if they close and reopen at different times, okay? Thank you. Rajkumar wish me a good week ahead. Me too. For me, 1800 is still possible, but I'm not expert. Well, we will say 1800 I will take, considering it's $100 cheaper, okay, for gold. May I have the recording for today's session? Okay, this could be the last recording. I just got a notice from Zoom. I got 2 Zoom accounts. One under my own company name, and this one is under the Trader Master. And both sent me an update saying that I have used too much of their resources, and my recording will come to an end. And for this, it will end on the 19th. So I would looks like they are forcing me to upgrade my account. Okay, so I think I should be able to give you the recording for today one. Okay, but beyond today, hopefully things changes. Okay, if not, I would spend more money to upgrade. All right, guys, I will see you in the coming week. We have one more week to go before we have Chinese New Year. So for Chinese out there, do enjoy your Chinese New Year holiday. I'll be going away with my family to nearby Batam Island. We can go very far because I have to celebrate my father's birthday, which is coming up very, very fast. So again, I just came back from KL, and the ambience in Kuala Lumpur has been quite interesting. so much more festive mood going on in Kuala Lumpur. Okay, guys, I do want to see you again next Sunday. So do lock in again next week. I'll see you. Bye-bye. For those who need a recording, reach out to me. I'll try to get you a recording. Okay, bye-bye.